inflation is by no means, and remember that the Federal Reserve in particular has been trying to get inflation down. That's been the number one objective until just the last couple of months. So if you're trying to get inflation down and it is still above your own target, that suggests that inflation is a lot more stubborn than most people recognize. And then the dollar, of course, has had a huge decline this year, and we've already talked about the dollar. So what I'm saying is that the economic environment is slowly shifting towards an environment that is attractive for gold. And investors are going to start pouring in when those inflation numbers pick up.
Relative strength index readings have oscillated between 60 to 70, indicating strong momentum without the extreme overbought conditions typically associated with speculative bubbles. What distinguishes this gold rally from previous cycles is its relatively orderly progression, despite the rapid price appreciation. Unlike the volatile swings seen in 2011 to 2012, the current gold market surge has maintained relatively low volatility, suggesting more sustainable, fundamentally driven buying. Renowned market expert Adrian Day emphasizes that gold's old-fashioned character is precisely what makes it enduring. He notes that recent strength in gold stems less from typical investors and more from central banks, wealthy families, and Chinese buyers seeking protection from currency risks and financial instability. China leads the world in gold production, mining approximately 370 to 375 tons annually, according to the U.S. Geological Survey's 2024 data. This domestic production forms a critical component of the nation's gold strategy. In his analysis, Adrian expects this demand to keep rising and warns that investors without gold are missing out. With the U.S. economy slowing, inflation staying high, and the dollar weakening, Day believes conditions are turning increasingly favorable for gold. Regarding the gold value, Adrian says gold serves as insurance, while gold equities still offer solid value. Even with the XAU index up over 100% this year, he maintains that gold stocks remain reasonably priced. He cites Agnico Eagle as the gold standard among miners, noting its valuation is lower than in previous years despite strong gains, evidence that gold stocks aren't overvalued. Adrian underscores it's not too late to invest, but advises expecting normal pullbacks, as gold equities have shown resilience even when gold prices were flat. Before we dive into Adrian Day's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
It is old-fashioned, and that's its strength. You know, it has been an asset that has been recognized around the world for 5,000 years in every culture and every period in history. So I think, if you like, that being old-fashioned is actually its strength. I think the thing that we must recognize as investors is that the drivers of gold for the last 3 years has not been investment demand. Whether it's central banks, whether it's wealthy families concerned about fiscal irresponsibility and wanting a defensive asset, whether it's non-official Chinese buying, concerned about the devaluation of the yuan and a little bit concerned about the stability of the banking system, and not wanting to get into real estate, which will be a traditional hedge, understandably not wanting to get into real estate and not allowed to get into crypto. But these drivers are not what I call traditional investment demand. And other than the non-official Chinese, they would tend to be fairly inelastic demand. In other words, the Central Bank of Poland doesn't say, gold's down $2 today. Why don't we buy some gold because looking at the Fibonacci numbers and the cup and handle, it might go up next week. No, they say we want to buy gold as a strategic asset. And the price, it's like buying insurance. Yes, you shop around to get a good deal, but if you're living in a floodplain, you don't say, I don't think we'll buy inflation, not this year. Let's wait till prices come down. No, of course not. You buy the insurance, and that's what's happening. So the price is very inelastic. And I think that demand is going to continue to go up. And investors who are not into gold yet, and as we know, the moves into the gold ETFs and other indicators would suggest that the public is certainly not rushing into gold. If you look at this year, the GLD, for example, and other gold ETFs have certainly had inflows, but certainly no rush of inflows. And if you talk to coin dealers, they'll tell you they're so busy, but they have as many calls with people wanting to sell their gold as buy their gold. Mm-hmm. I think if people are not invested in gold at this point, that's a huge mistake, because investors are going to turn to gold at some point, and they typically turn to gold when in North America, where we don't have this long history of using gold as an asset of last resort. In Switzerland, in Germany with the Weimar, still fresh in people's minds. Same in France, of course. They remember. Same in Vietnam. People remember what gold can actually do for you in terms of, forget it going up in price, but just being able to survive, or leave the country and start a new life or whatever. We don't have that in the US or Canada. So we tend to buy gold based purely on investments. Well, the investment scenario that is most attractive for gold is a declining economy, low and declining interest rates, to the point where they become negative real rates, high and rising inflation, and a declining dollar. Well, we haven't had that. That hasn't been the case for the last 3 years. Certainly the narrative has not been that. But it's slowly turning in that direction. You can't ignore the signs of a declining economy, particularly the labor market in the US. Inflation is well above, after it stabilized from the decline from COVID, it is above, it's above where it was before COVID. For 5 years before COVID, inflation was never as high as it is now. And it's also above the central bank's arbitrary 2% target. So inflation is by no means, and remember that the Federal Reserve in particular has been trying to get inflation down. That's been the number one objective until just the last couple of months. So if you're trying to get inflation down and it is still above your own target, that suggests that inflation is a lot more stubborn than most people recognize. And then the dollar, of course, has had a huge decline this year, and we've already talked about the dollar. So what I'm saying is that the economic environment is slowly shifting towards an environment that is attractive for gold. And investors are going to start pouring in when those inflation numbers pick up. First of all, gold as insurance, you should be fairly price inelastic and not be overly concerned about the price that you're paying. But gold, I'll say gold in quotes, gold assets, including the equities as an investment, you obviously do want to be concerned about price. Now, what I'll say is that if you look at the gold stocks, what are they? The XAUs up over 100% this year to date. So for a value investor, the immediate reaction would be a little bit of caution. But remember, Oscar Wilde told us to look at value, not at price. And if you look at the value of the gold stocks, they are actually no more, they're certainly not overvalued. And on most metrics, most gold stocks are trading at valuations that are below their long-term average. And in some cases, far below their long-term averages. And a good example, if I may, would be Agnico Eagle, which is without question the gold standard of major gold miners. And I use Agnico because nobody accuses you of, if you pick Barrick, they'll say, oh, well, yeah, that's cheap because of Pakistan. And Bristow's just been fired, and Mali and everything else. But if you look at Agnico, there's no hairs on that dog, as they say. And if you look at their price to free cash flow today, certainly highs like 38 times, but gold stocks always trade at high multiples. Remember that. That's higher than it was at the beginning of the year, but it is actually lower than it has been for every other year of the last 5 years. Think about that. Agnico Eagle, whose stock price has more than doubled this year, and it's quadrupled in the last 5 years, is trading at lower multiples today than it was in 2023, 2022, 2021, 2020. So are the gold stocks cheap? I say, are they good value? Sorry. I think they are still good value. And have you missed the boat? Absolutely not. Now, clearly, if gold has a pause or drops for 20, if gold has a correction, the gold stocks are going to give back a lot of those gains. But it's interesting, you look at from April to beginning of August, when gold was basically flat, right? Or in fact, yeah, from end of April to pretty much the third week of August, gold was absolutely flat. And what happened to gold stocks during that period? They actually went up marginally. So I think you need gold to actually correct for the gold stocks to decline.
Adrian Day notes that the U.S. has long relied on the dollar's reserve currency power to overspend, but he believes that dominance is fading. He expects a shift toward a multipolar system where multiple currencies share global reserve status. Adrian notes that the dollar's share of global central bank reserves has fallen sharply from about 78% in 1999 to around 48% today. Initially, central banks diversified simply to reduce overconcentration, but growing concerns about U.S. fiscal deficits and the weaponization of the dollar as a political tool have accelerated the decline. Recently, between 2023 and 2025, central banks worldwide, especially in emerging markets, have been expanding gold reserves at a remarkable pace. This surge in gold buying underscores a collective desire to manage risk and strengthen financial sovereignty amid global uncertainty. Its power as an inflation protector is compelling. Since 2000, the US dollar's real purchasing power has fallen by over 40%, yet gold prices have soared over 600%. That contrast tells a straightforward story. When currencies lose value, gold doesn't just hold steady, it shines. Concurrently, Adrian clarifies he's not predicting runaway inflation or a total loss of dollar dominance. Still, as the dollar's supremacy fades, countries will buy fewer dollars and sell more, redirecting some of that value into gold. This could weaken the dollar further and fuel moderate inflation over time. Let's get back to the interview.
Now, the US is in a unique situation where, with the dollar as the world's reserve currency, it has been able to print far more money than is needed for its own domestic needs, knowing that that money will always be consumed or will always be demanded, wanted by other countries around the world. And that means that the US has been able to spend beyond its means, and Americans don't understand that, because it was the same in Britain in the 30s, well, 40s was the war, of course, where countries frequently spend beyond their means, but people don't realize that, and export inflation. So the inflation is basically exported. That era is probably coming to an end. I'm not suggesting that another currency will replace the dollar anytime soon. That's been a big debate, if you like, or the big subject for the last 20 years. The dollar's this, the dollar's that, but what's going to replace it? Well, we're now seeing that maybe nothing is going to replace it, or not so much nothing, but no one single currency is just going to replace the dollar. But, we're heading into this bipolar and multipolar world. And some of the people around Trump in the Mar-a-Lago, what's generally called the Mar-a-Lago Accord, some of the people who've written for that, like Steve Barron, who's now on the Federal Reserve Board, Steve Bannon, who's not in the administration, he was in the last one, but he's still influential. They've written about how there's the US sphere and there can be the Chinese sphere. And in the US sphere, the US will help defend you. You get preferential access to our markets. We expect you to buy our treasuries. And in the Chinese sphere, we don't protect you. If you want to go with China, let them protect you. We don't protect you. You don't get preferential access to our markets. And yeah, sure, we don't expect you to buy our treasuries. But if you dump them too quickly, we'll punish you. So that the world of a single reserve currency asset is probably ending. And what I would say, and I'll stop here, what I would say is that to the extent that the US dollar loses its sole dominance as a reserve currency, then to that extent, countries will start, first of all, not buying dollars, and secondly, selling the dollars. And to that extent, then some of that money will go into gold. The dollar will lose its value against other currencies, and inflation will pick up. Long answer, but and that's something that's been going on for 25 years, but it's probably coming to a head fairly soon. I'm not suggesting we're going to get runaway inflation any day soon. I'm certainly not suggesting that, because the US is not going to totally lose its reserve currency status. It's just going to be shared with other people. So, when you look at reserve currency status, you're primarily looking at two things. To what extent is the dollar used in global trade that doesn't affect the US? And secondly, to what extent is it a reserve asset of primarily central banks, but frankly also other banks? Now, on the first, on the trade, the US is still the dominant currency in which people conduct trade. It's losing it a little bit, but at the margin. Like Brazil and Russia will have an agreement to buy Russian oil in rubles or something, and Saudi Arabia and China will have an agreement that they'll do their oil trading in a currency other than the US dollar. So it's losing it at the margin. The more dramatic thing is with the dollar as a reserve currency. In 2000, a year, or 1999, at 1999, the dollar was over 75%. It was about 78% of all central banks' foreign assets. And by foreign assets, I mean not the pound for the British bank, not the euro for the French bank, and so on, but all foreign assets. The dollar was 78% at the beginning of the decade. By 5 years ago, that had fallen to about 65%. Last year, it was 58%. Right now, it's at about 48%. That is a very, very dramatic decline in a reserve asset of central banks, which tend to move slowly. Central banks are not day traders. I was talking to someone the other day, and we talked about the dollar and gold. What do you attribute it to? And he gave one word answer, which was Trump. And that, now, to me, I'm not going to get political, but to me, that's just nonsense. As I've just shown, the dollar reserves in central banks have been declining and declining steadily for 25 years. I will say that there's nothing that this administration is doing to arrest that decline, but it's something that predates them and is going to postdate them. And so I'll get to answering your question in a minute. And so the question is, originally, central banks started selling dollars because it was just too much concentration. 78% of your reserves in one asset is just too much concentration. It's particularly too much concentration if you're concerned about the fiscal situation of the US, which we are. And that concern has not really... It's not ameliorated at all in the last 25 years, as we were talking about earlier. And so the concern that you've got a country running huge fiscal deficits, right, as well as trade deficits, huge fiscal deficits, and we've got the majority of our reserves, that calls for diversification in any event. Founding of the euro helped because it meant you had a bigger currency that you were able to put some of your reserves into. Then, of course, you had the weaponization of the dollar, which again predated the current administration. I have to keep emphasizing that for people who want to blame Trump for everything that goes on in this world. And that predated 2022, frankly. It predated the confiscation of Russian reserves. We've had U.S. weaponization of the dollar increasingly, for 10 years now.
Financial education programs highlight gold's role in preserving purchasing power during periods of currency volatility, reinforcing public support for the national gold strategy. Gold plays a central role in China's engagement with BRICS partners and other emerging economies, providing a neutral foundation for economic cooperation outside Western financial systems. Multiple experts have predicted that gold prices could reach or exceed $8,000 per ounce potentially as soon as 2028 or within the next decade, with some forecasting an even higher $10,000. As the dollar's dominance fades and gold reclaims its role as real money, will gold continue to rise as global demand and inflation pressures grow? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.